Hey guys, hope everything's going well. You guys know that drill. Smash the like button, subscribe if you haven't, and comment down below. For anyone that is interested in my sports card content, just YouTube AIH Sports. Okay, a few things. Yesterday I talked about gold. I talked about how I believed we are in store for a rally. Now, my ideal point of when this should rally right around the Fed when they raise the first rates from 0% to 25 basis points, as what happened in 2015, 2016. They raised the rates, then gold picked up. And I would like another move to the downside in metals so I could get in a few miners. I like trading around the Franco Nevada stock, which is a gold streaming company. Alrighty, putting that aside, I wanted to get into the topic of inflation versus deflation. And we see a lot of headlines right now, even in the mainstream media, they're talking about inflation. And yes, this is what we have right now. If you go to the grocery store, you could see all the items that you used to get in the past. While some may remain the same price, it is known as shrinkflation, where you get the same goods, but same price, but it's just less in quantity. And yeah, we're just seeing it all across the board. I buy bagels for breakfast. Some of these bagels, minus maybe except when I go to Costco, the portion size is much smaller. So yes, that is inflation. Yes, we have shortages of food still. I go to Whole Foods, for instance, and I can't find the cream cheese that I'm looking for. Or I don't get it in the tub form. I like it in the tub form, now I have to get in the rectangular form. Regardless, that is the result of shortages and leading to inflation. And what is causing this? Partially, it is due to the monetary policy of what the Fed did starting in 2020. And also, I would argue that it's the mandates. It is people need to take the jab, and not everyone's complying. And then also, people don't want to work in these conditions. They don't want to work where they have to wear a mask. Whether you agree with that or not, that's just the sentiment out there. So when you're looking at all of this, you would think, oh my God, interest rates need to go sky high. It needs to go to 5, 6%. And I'm just looking at it right now. And I'm just looking at the 10-year yield. 10-year yield is close to 2%. I would expect that the inflation, not the inflation, just the interest rate should be much higher on the long end of the curve, but it's not. That is really interesting. So, despite the inflation that we have right now, long term, it seems that sophisticated investors, traders, etc., aren't seeing higher inflation down the road. While later this decade, we may have crazy inflation again. Just in the interim, we are not seeing inflation expectations too high, which is quite interesting. And what are the things that I'm looking at from a long term perspective? I'm looking at, for instance, the euro dollar futures rate or the euro dollar futures. And I'm looking at the curve of the euro dollar futures. And why am I looking at it? Because it shows what the curve is going to be a few years from now. I want to see whether it's upward sloping, whether it's going to be downward sloping, is the yield flattening. And for those that don't know what euro dollars are, they're basically dollars held abroad during World War II. They just created this system for easy access to dollars, from my understanding. And when you look at all these curves, you want to see them upward sloping. For instance, the yield curve that many people use in the United States you want to make sure that the 10-year yield is greater than the 2-year yield or the Fed funds rate. If there's ever an inversion, you know there's problems in the funding market. Now, why you have to ask yourself this question. Why are sophisticated traders as early now as late to 2023, why is that yield slightly inverting? It's not by that much. Maybe I'll show graphs in a video the other day or in the next few days. I did that in my sports card video, and people are like, well, what is this? But people watching here probably understand these concepts a little better. When I did it on the sports card video, I saw the curve inverting in late 2024 and early 2025. But now it's starting to invert in late 2023. And also, you don't, and parts of 2024. And that is really interesting. Whenever you see an inversion of the yields, that means that traders and sophisticated investors are predicting not inflation, but deflation. And I've talked about how I believe the stock market will probably top out by 2024. I am still bullish right now. I don't expect it to go in a straight line. Regardless, I've been looking at various cycles, Elliott wave theory, and a few others. And 2024 seems to be the time where the recession is going to happen. And what these traders are showing is stress probably in the banking sector as early as late as 2023. That is really interesting. Really, really interesting. So, why I would argue we would be moving to what mainstream economists call as deflation is because number one, I first of all, before I get into it, I don't agree in how the mainstream economists define inflation and deflation, but I'm just using their terminology. But deflation in the next few years, or not as high inflation as we're seeing, is because number one, we're seeing the flattening of the Eurodollar futures curve over the next few years, and also an inversion in some months as early as late 2023. Two, right now, I don't see the 10-year yield extremely high. I mean, there were talks about raising interest rates to 2%, and the Chinese were not in favor of it. And that 2% will take a few years to get to, but I'm pretty sure we're going to get to it. And by that time, the yield curve was probably going to be negative. Inverted yield curve. It's foreshadowing a recession. So we're just looking at all of that. And people may say, like, hey, look, oil prices are up. Yes, oil prices are up year over year compared to 2 years ago. We had negative, $40 in the futures curve or in the futures market in May of 2020. And now we're at $90 a barrel. Okay. Yeah, we've definitely seen inflation in the past few years. Now, if you want to compare it to maybe 2015, we're seeing oil prices remain constant. And also, another point I wanted to point out is I got a comment on the sports card channel saying that, hey, okay, you talked about in the 80s they raised Fed funds rate to 20 to curve out inflation. And then in the 1990s, when the sports card market imploded, the Fed funds rate was 5%. You think that they just raised the Fed funds rate to 2%, that you're going to get rid of this inflation? Well, I believe there's many factors going on. You could raise it to 2%. What happened under Trump, and there were already problems brewing in the Eurodollar market. And then later, the repo market had issues. And the whole economy came tumbling down, and you had temporary deflation. You had oil go back, $20, $30, whatever it was. So this time around, what could we have? We could have an oil shock that could change an environment that's inflationary to deflation within a few months. I could see that within a few years. You have to remember, there have been times where there have been oil shocks in the US economy. If you go back to, I think it's the 73 embargo, you had 1979 oil prices skyrocketed. You're in a recession with what was going on in Iran. And you have to remember the 1970s was a time where they got rid of the gold standard, so you have more inflation at that moment than you did beforehand. You weren't subjugated to a gold standard as you were in the 1970s. And 2008, you had an oil shock. What, in August? Oil was what, close to $140 a barrel? And within what, 4 or 5 months, oil crashed down to $30. So you went from what mainstream economists would call an inflationary time to a deflationary time really quickly within a few months. And I wouldn't be surprised if oil goes back over triple digits, maybe it goes back to 130, 140 like it in 2008. And guess what? The economy is probably not going to be able to handle it. They're not going to be able to handle the higher interest rates and the yield curve going negative, not negative, but becoming inverted. So, therefore, I believe it will be in line with what we're seeing right now in the Eurodollar futures. Flattening yield curve there, also inverted, and then two, the oil shock that comes with it. So yeah, that's what I'm looking at right now. Once again, I'm still bullish on risk assets for the time being, next year or so, but I want to get defensive, and I'll probably get defensive more earlier than most individuals. It's just that 2024 probably is going to be a crazy year, guys. Anyways, guys, let me know what you think. Do you think I'm off base? Do you think I'm correct? Let me know. Smash that like button, subscribe if you haven't, comment down below, guys. Thanks. Bye.